Welcome back, everyone, to my world of stocks. I know this is Saturday. We would normally do a weekly stock market update video today, but instead, I'm going to talk about something else because four of my absolute favorite stocks crashed this week on earnings, and I just got to make a video for you guys to update you on it. So, today, instead, we're only going to be talking about Google, Microsoft, Amazon, and Meta. Again, all four stocks this week crashed on earnings. They're down huge from their highs. Unbelievable how much they've fallen. And because I own stock in every single one of these, including Microsoft, which is my number one largest investment in my entire portfolio, I'm going to break down for you guys those earnings, let you know exactly what happened, give you my updated opinion on these stocks, and let you know why I'm going to be buying a ton of these stocks in the coming months for the long term. It's going to be a fun one. Hope you guys enjoy it, but let's not waste any time. Let's just go ahead and dive straight into this and take a look at what's going on here. Okay, now the crashing really started with Microsoft, who was the first of the group to report earnings back on Tuesday after the market closed. And the following 2 days, Microsoft stock had crashed by almost 10%, leaving them down about 30% so far this year. In my opinion, though, the quarter was actually not that bad, as Microsoft beat on both the top and bottom line with gigantic sales of over $50 billion that still managed to grow by a double-digit 11% despite that already massive size. However, the next quarter is really what seemed to spook investors, as management expects that growth will plummet all the way down to just 2% because of, quote, a deteriorating PC market coming off of the pandemic where less people are buying new computers. For example, revenue from Windows licenses that they sell to device makers who use Windows on their systems, well, that actually dropped by 15% year over year, making it the worst quarterly drop since 2015. And if you think that's bad, it's expected to fall by even more at over a 30% decline next quarter. That's because, according to Gartner Research, PC shipments fell by about 20% this quarter throughout the entire world, making it the largest decline in over 2 decades. That's why you've been seeing so many chip stocks, for example, like AMD, Nvidia, and Intel just being, crushed recently because their sales are being affected by this too. On top of that, cloud revenue grew by a monstrous 35% in the quarter, which is huge and very impressive in my opinion, since cloud segments for Microsoft make up around half their sales, but it was not enough growth for analysts who wanted to see even higher growth of 36%, and it was also lower than the 40% growth that they saw the previous quarter, another indication that growth may be slowing down here. However, you got to keep all of this stuff in context because we're seeing year over year comparisons to 2021, which was a monstrous year fueled by pandemic stimulus as well as high technology demand because of people staying home and everything else going on, where Microsoft was growing sales north of 20%. That's something that should not be happening at their massive size. So, yeah, of course it's going to be correcting back down now, especially with the horrible economy, which I'll show you more evidence for in just a second. But even though the correction is healthy, it's just a little too steep at only 2% growth next quarter, and the stock fell as a result of that. Speaking of a horrible economy, though, Google was next to report earnings. I know it's Alphabet, I like to say Google, whatever. But Google was next to report earnings on Wednesday morning, which sent the stock crashing by over 10% in the following couple days, leaving it now down well over 30% year to date. And here, look guys, the story was all about a weaker advertising market because of the deteriorating macroeconomy where companies are starting to cut their advertising budgets in order to save money and better prepare, which caused Google stock to have their worst trading day since March of 2020 when the pandemic lockdowns first started. Overall, Google missed on both top and bottom line estimates while only growing their sales by a single digit 6%, which, by the way, get this, it's down gigantically from the 41% growth that they saw the year before. So they saw giant growth the year before. But again, that's an insanely hard comparison to last year. So I don't personally care that it had such a low growth quarter because I think it's impressive that they were able to put up just literally any growth at all, and especially for their size, doing over $54 billion in just advertising sales alone. and having such a horrible, such a hard comparison to the year prior. Still, it was their weakest quarter of growth in almost a decade if you exclude 2020, with their ad sales only increasing slightly year over year. And really, the biggest story of all was their YouTube business. Not only missing targets, but it was actually a decline year over year of around 2%. Again, companies are spending less. That's going to dramatically hurt YouTube ad revenue, and they actually saw a decline. After that, though, Meta reported earnings, which not only did the stock fall by about 6% on Wednesday, but it went on to crash by an unbelievable 25% on Thursday, leaving it now down over 70% this year. So crazy. And here the story was all about declining growth, while their profits also continue to plummet because of their super heavy investments into the metaverse that is literally costing them billions of dollars every quarter. Now, on the bright side, they at least managed to beat on revenue while also growing their user base to almost 3 billion monthly active users, which also beat expectations, but it wasn't enough to lift the company up, as average revenue per user fell short of expectations because of the large decline in ad spending across the economy, coupled with, of course, the Apple privacy changes that hurts Meta's business, as well as the rising competition from rival TikTok. All of those things causing them to not only miss earnings and provide lower guidance than expected for the next quarter, but this also marked the second consecutive quarter of a sales decline, this time 4% decline, while also indicating another drop in the fourth quarter, which would make it the first time ever that Meta has seen 3 consecutive quarters of negative revenue growth. So it is a pretty big deal. And as if all of that wasn't bad enough, their investments into the metaverse, which is grouped into their Reality Labs segment, has now caused their expenses to rise by almost 20% year over year, while also sinking their net income by over 50%. And in total, that segment has now lost over $9 billion this year with no real end in sight, as Meta guided for even bigger losses next year before they finally start to slow down those investments and work towards actually growing their operating income over the long term. Okay, and after that came the big dog Amazon, who, you guessed it, they also got completely destroyed, falling by close to 20% in just the past 3 days alone, leaving them now down about 40% year to date. And here too, the story was all about weaker guidance and slowing growth. Now, first of all, revenue did miss for the quarter, but it was still up 15% year over year. So I couldn't care less that they missed. I mean, you're talking about over $120 billion in a single quarter. If analysts can't appreciate 15% growth at that size, I mean, I don't know what to tell them. They're out of their minds. That's unbelievable growth. And a huge highlight was actually advertising, which surprisingly beat estimates at a time when so many other companies are struggling with it. So that was a very positive surprise. However, the real concerns came from Amazon Web Services missing estimates, since that generates all of their profits. And the other concern was guidance, as they expect revenue growth to plummet from around 15% this quarter to just 2 to 8% next quarter. And by the way, next quarter is the holiday shopping season, which is normally their strongest quarter. But Amazon pointed out during the earnings call that inflation, interest rates, and the macroeconomy are causing a major slowdown in their retail business, which is further exacerbated by lockdowns ending and people returning to physical retail stores rather than shopping exclusively online, which boosted their sales by a giant amount last year and is making for a very hard comparison this year, just like all the other companies that we've been talking about. Now, they also mentioned that the economic environment in Europe is also hurting their business because of the Ukraine war as well as the current energy crisis. And as a result, Amazon is doing everything they can to cut costs and better prepare for falling profits, which we've already seen huge examples of, as earlier this year, Amazon has already closed more than 20 different fulfillment centers after opening a ton of them during the pandemic because of the increased demand. But they also froze corporate hirings. They abandoned new projects like their delivery robots and their video calling device for kids. And they even went as far as to completely get rid of their telemedicine Amazon Care division, which I'm actually happy about myself because I'm invested in Teladoc Health, which is a big rival to them. But all of these changes are because their operating income crashed by almost half this quarter, dropping from 4.9 billion down to 2.5 billion, which again comes entirely from their Amazon Web Services cloud segment, which is also struggling, by the way, as it posted its slowest revenue growth since they started posting individual results for it back in 2014. Again, though, the biggest highlight for Amazon was their advertising business that is defying all odds, and it posted huge growth of 25% year over year. But even that wasn't enough to lift up the rest of the business, and overall, it's setting up for very small growth in the fourth quarter and during the holiday season, which analysts expect there to only be 2.5% growth for the entire online shopping market, despite it being, a holiday season. So, with all of these horrible conditions in mind, why in the world would I still be bullish on these stocks long term and be buying at these lower prices the more that they fall? Well, I can actually make it very simple for you guys from both a long term and even a short term perspective. Now, when looking at the short term, I just think that all of these issues are temporary that will eventually go away over time. What's the biggest issue with the macroeconomy right now? It's inflation and rising interest rates, right? Well, we already know that the economy is cooling down. We can clearly see that in some of these earnings reports. We know that corporations are spending less on advertising, so they're trying to cut down on their budgets. We know that consumers are spending less because retailers are being affected already, like Amazon, who is also guiding lower for next quarter. We've already seen other big giant retailers like Target and Walmart report weaker profits because they've had to put so much of their stock on clearance because they have so much backlog, so much overstock from the restoration of supply chains that has led to an increase in supply with not enough demand. So they've had to put stuff on clearance, which, by the way, is one of the biggest reasons why Amazon is guiding lower next quarter in the holiday shopping season, because they've already been putting a ton of stuff on sale and on discounts, and they've been having special sale events well before Black Friday and the Christmas rush. So when you add it all up, you have a cooling economy, you have lower spending, you have supply chains being restored, you have overstock going on clearance, and on top of all of this, you have the highest interest rates since the Great Recession. So inflation is going to come down. The question is how soon? I'm not exactly sure, but it might be a lot sooner than people think. There's a lot of things happening right now that should impact inflation in a huge way to the downside. And when that happens, I think we're going to see the next major economic expansion and recovery as interest rates start to fall because of all of this. The issue, of course, is that in the meantime there may be a recession. In the meantime, the economy and the stock market will likely continue to take hits. It'll likely continue to be extremely volatile. That's all a given. But right now, I'm seeing some of the best stocks in the world, some of the best companies, most well-run companies out there trading at unbelievably low prices. And they're also giving very low guidance for the future, which may be a lot easier to beat than you might expect. So that also could lead to some upside potential depending on how soon a recovery starts to happen within the economy and within, inflation, interest rates, and all those things. So I just feel like rather than dealing with the headache of trying to time all of this perfectly, I just feel that I'm ready to start buying these stocks. Well, I've already been buying, but I'm ready to continue buying. The more that these stocks fall, I just see some great deals out there, and I'm going to continue buying the more that these prices fall. And the thing is, guys, we oftentimes look at some of these giant behemoths and we think that they can just continue to grow at these really high rates despite their already massive size year after year, every single year consecutively, and they should never miss a beat. That's not realistic. These companies have to have corrections. The economy has to have corrections. It's healthy for it. And right now we're seeing some of that. And I just think it's a down time, a down period. And it'll ultimately be a buying opportunity, in my opinion. That's how I feel about it, because I'm getting some companies here that are hugely dominant in their markets with unbelievable financials, and they're trading at super low prices. I mean, look at Google. You're talking about a market leader in basically everything internet related, including search, browser, email, maps, phone operating system with Android, the list goes on. Microsoft, you're talking leadership in business software, computer operating system, Windows, gaming, of course, cloud is like growing into the biggest part of their business now. Meta, huge presence in social media, right? A social media leader. Online advertising, they are growing. They have a growing presence in shopping as well, and they're implementing that into all their platforms. And they're even making future investments on things like the metaverse so that they can at least remain relevant in the future. And Amazon, I mean, you're talking about online shopping, growing advertising sales, the biggest cloud platform in the world. Do you really think that any of those areas are going to get any smaller over the long term? They're only going to get bigger. And then you look at financials and valuations after these stock crashes. Okay, well, Google, largest crash that I've ever seen in the stock, down almost 40% from its highs, leaving their PEG ratio at not only about 1, but over 10% cheaper than the sector and over 30% cheaper than their own 5-year average. A company like Google trading cheaper than the sector, that's insane. Financially, over $250 billion in sales last year that grew over 40%, and profits of over $76 billion that almost doubled. I mean, I'm more than happy to give Google a correction year, but they're not even doing that either. Their sales are still expected to climb by double-digit percentage this year. I'm sorry, but people are crazy for not seeing the value of Google stock long term. Microsoft, again, biggest crash that I've ever seen, down well over 30% from its highs. Valuation still a little pricey, around 12% higher than the sector on a forward P ratio basis, but over 20% cheaper than their own average. Plus, you get a nice growth oriented dividend with a 1.2% yield, a tiny payout ratio of 27%, about a double digit growth rate, and close to 2 decades of consecutive growth, which is when they started paying it. And forget about the financials. This is one of the most reliably profitable and gigantic businesses in the entire world, doing over $50 billion less than Google on revenue, and yet they still managed to put up about the same profits at over $70 billion. That's insane profitability. And they're expected to continue growing by about a double digit percentage in the future years as well. Amazon, okay, you're talking about a dominant leader here that does almost $500 billion in sales and nearly tripled their profits over the last couple years. And yet the stock has lost almost half of its entire value, as if all of that growth never even happened. How big of a dip are you looking for here? I mean, that's crazy how much it's fallen. And Meta, okay, with Meta, I can understand not wanting to risk it because they're investing so heavy in the metaverse, which still needs to be proven how big of a market that'll be over the long term. But even just with what Meta is right now, and at least some kind of future potential in the metaverse, whatever that turns out to be, you're still talking about a stock here that has now crumbled down by almost 75% from its highs, 3/4 of its entire value gone just like that, leaving their valuation at 30 to 40% cheaper than the sector, despite them being the world leader in social media with about half the world's entire population using their products, and gigantic financials that grew sales by over $30 billion just last year alone, while profits soared by about $10 billion to go along with it. I mean, I just think that they're allowed to take a couple years off here to invest in something new. Sales will be flat this year, but return to growth next year. I personally feel that it's not a huge deal. And that's really my overall feeling on all of this stuff that's going on here. Yes, it's a concern. Yes, stocks should be falling, but they are. They're crashing by gigantic amounts. And at some point, it gets to a point where they have fallen by too much, and I think it's a little overblown. And look, you could forget Meta. I know that that's the stock that everybody hates right now. It's too risky. Fine. Look at it as a speculative stock because they're investing in the metaverse, right? We don't really know the future of the metaverse, how big it'll be. Fine, so it's speculative. Okay, Meta's a speculative stock that is trading super cheaper than the sector, as it should because it's speculative, right? And they do $120 billion in sales with around half the world's entire population using their products. Okay, that's a spec stock that I'm willing to bet on. And look, again, forget Meta. I get it. It's too risky. I totally understand. I feel you on that one. But Google, Microsoft, Amazon at these prices, I just think over the long term, I'm going to be happy with my investments. So the more that they fall, I'm going to keep buying. Again, they probably will continue to fall. Things are going to remain super volatile. I've been telling you guys that in almost every one of my videos. But I just think that there is a lot of value here if I really think, 5 to 10 years out or more. And these are stocks that I really want to hold for like the rest of my life. So these are very long-term investments. But anyway, that's just how I feel. Who cares what I think, guys? I would love to hear what you guys have to say down below. So leave me your comments. I'll respond to them. We'll have some nice chats about it and it'll be a lot of fun. But thank you so much for stopping by, for supporting the channel. It really means a lot to me. And I'll catch you in the next one. Hope you're all doing well. Take care. Bye-bye.